series of educational webinars over the last several years, and I really enjoy doing them. And Tom, thanks for setting this up, taking the time to set up these educational webinars.
My pleasure, Chuck.
Okay, and today we're going to look at the global paratrend system, which is an ETF trend trading system I've been using for many years. And we're going to take a look at trading ETFs and ETF options using the global paratrend system. And the global paratrend system utilizes the major trend system to trade ETFs and ETF options. And we take both bullish and bearish trades with the global paratrend system. And the goal of GPS is to identify the major price trends in a broadly diversified portfolio of global markets. And this trend identification in these diverse global markets has resulted in a very consistent flow of trading profits, both from long and short trades. We currently don't have any short trades on, but we did. We were heavily short in the last bear market thanks to GPS, and I'll show you some of those trades that we took during a bear market. So GPS is a trend following system that allows us to trade with the trend instead of trying to predict where the future price movement of a market is going to be. And GPS only allows trades in the direction of the major trend. So using GPS, a bullish trade is taken only if the major trend is bullish, and a bearish trade is taken only if the major trend is bearish. And I found over a time that trading in the direction of the major trend helps prevent whipsaw trades when you have short-term counter-trend rallies or short-term counter-trend sell-offs. So preventing these whipsaw-type trades can increase your profits, reduce losses, and increase the percentage of winning trades. So basically, ETFs, or exchange-traded funds, are portfolios of stocks, bonds, currencies, or commodities that trade as a single stock on a stock exchange. And ETFs have been around since 1993 and have really gained popularity over the last decade. They're not mutual funds, but they offer some of the same advantages as mutual funds do while trading as a stock. And the main difference is you can trade the ETFs during the day as opposed to the typical mutual fund, which you only buy or sell on the close. And ETFs, they hold a pool of securities, and they're built to track a specific index or sector or currency or commodity. So there's over 740 ETFs today that track numerous market indexes and sectors. Here's an example of some currency ETFs: Australian dollar, British pound, Canadian dollar, Mexican peso. Here's some examples of commodity ETFs: agricultural, grains, livestock, oil, copper, energy, gold, silver, base metals. And here's some examples of equity ETFs that hold baskets of stocks. Some examples of that would be the emerging markets, the BRIC index, emerging market index fund, market vectors Russia, and there's also short ETFs that profit inversely. In other words, if the price of the ETF goes up, a short ETF will lose money. If the price of the underlying ETF goes down, a short ETF will profit. So there's also reverse ETFs that you can use during down markets. And I'll show you some examples of trades I took using short ETFs. There's the Chindia Index, Asia 50, China 25, Hong Kong. So there's a wide variety of ETFs available today, not only for equities, but for fixed income, commodities, currencies. So what this allows us to do is diversify our the assets that we have in our trading portfolio. I've been trading ETFs almost since the inception of ETFs using my trend following systems. And let's just go through some of the advantages of GPS trading, ETF trading. It allows us to invest in the global currency, commodity, and equity markets that have the greatest profit potential. Allows you to diversify your investments across a wide range of asset classes. Allows you to trade from the long or short side, which increases the profit opportunities. Reduces the market risk of owning individual stocks, and all the GPS trades are limited risk trades. So whenever you trade individual stocks, you're always susceptible to bad news or bad earnings reports that can drive the price of the stock down. And let's take a look at an example of a price chart of Bristol Myers, the drug company. Bristol Myers had a bad earnings report, and we can see in this time frame the price of Bristol Myers went down in August, and it showed a loss in August. However, the pharmaceutical holders ETF contains Bristol Myers stock, and you can see over the same time period that the ETF actually had a profit in the month of August, even though it holds Bristol Myers stock as one of the bigger positions. So you can see how an ETF reduces that specific stock risk that you always incur when you own stocks as opposed to ETFs. So all the GPS strategies are what I call limited risk strategies, and what that means is you can't lose more money than you invest, regardless of adverse market moves. You're not going to get a margin call from your broker to add funds to your account. So I like to keep all of my trading using limited risk strategies where you can't lose more money than you invest. And some examples of the strategies we use for GPS would be the call and put option purchases, call and put option spreads, bearish ETF fund purchases, and covered calls. These are all limited risk strategies using the GPS system. And what I consider high-risk trades would be investments such as futures, forex, shorting stocks, selling naked options. With these types of strategies, you can wind up getting a margin call and losing more money than you have invested in your account. So if you're using one of these types of investments and you're leveraged 20 to 1 or maybe 50 to 1, it doesn't take much of an adverse move for you to lose all of the cash in your account and incur a margin call. So again, GPS allows us to trade with the trend instead of trying to predict the future price movement of a sector or index. And the GPS uses the 1-month price of an ETF in relation to its 20-month exponential moving average. And if the 1-month price of an ETF is above the 20-month exponential moving average, then a bullish major trend is indicated. And if the 1-month price is below the 20-month EMA, a bearish major trend is indicated. So this simple system has been very effective in identifying the major trend in global markets. Again, if the market will be on a buy signal if the 1-month price is above the 20-month EMA, and the market's on a sell signal if the 1-month price is below the 20-month EMA. And we can download the 1-month and 20-month EMA prices from stockcharts.com. So let's take a look at some current examples of the major trend. And you can see it only takes a few seconds to download these charts. But once we download a chart, this first one is for the Home Builders Index ETF. And we can see this line right here is the 1-month price, and it's above the 20-month EMA, which is this blue line. So once we download these charts, we can instantly see whether a market's on a buy signal or a sell signal. So we get the big picture of the market right away, and it only takes a few seconds to download these charts. So just by looking at this chart, you can see the Home Builders ETF is in a very strong price uptrend, and the 1-month price has remained above the 20-month EMA, indicating a buy signal with the major trend system. And we can see in this buy signal occurred in November of 2011. So in November 2011, the 1-month price crossed above the 20-month EMA, and the home builders at that point was on a buy signal and has continued to be on a buy signal. Here's another example. This is the healthcare sector ETF, and again we can see that 1-month price above the 20-month EMA, indicating a buy signal, and the major trend is up. Here's a couple examples of sell signals. This first one is for the Japanese yen, and we can see in October of last year, the 1-month price crossed below the 20-month EMA, so the yen at that point was on a sell signal. And you can see that the 1-month price has remained below the 20-month EMA, so the Japanese yen remains on a sell signal. Here's another example of a current sell signal, and this is the ProShares. This is the short financials. So this is one of those inverse ETFs that moves inverse to the financials ETF, and we can see the 1-month price crossing below the 20-month EMA right here, and it continues to remain below the 20-month EMA. So the short ETF, financial ETF, remains on a sell signal. So those are two examples of current sell signals. Now, one of the advantages of the major trend system is it allows us to focus on markets that have very clear trends and avoid markets that are not trending. And here's a good example. This is the iShares Silver Trust. So this tracks the price of silver, and you can see the 1-month price here fluctuating above and below the 20-month EMA. So not really on a clear trend, except for these last several months. It's clearly in a downtrend. But it allows, if you pull up the major trend system and you look at this 1-month price in relation to the 20-month EMA, you can see right away that why even bother trying to trade the silver market with this kind of volatility when you could trade the healthcare sector instead with a very clear trend. So that's one of the advantages of pulling up the major trend system. You can see right away which markets are trending and which markets are not trending. And let's take a quick look at some of the ETFs that I currently own in my brokerage account. Here's this first one is the Consumer Staples ETF. We can see clearly in a price uptrend. This is the 1-month price, and here's the 20-month EMA. I also own the healthcare sector, and here's a chart of the Ultra S&P 500. This is a leveraged fund and moves at 2 times the underlying S&P 500 index. So if the fund meets its daily objective, if the S&P is up 1% for a day, the SSO will be up 2% for the day, and if the S&P is down 1%, the SSO will be down 2%. So this is a 2-to-1 leveraged fund, And I also own the financial ETF, which we can see went bullish last summer, and has remained in a strong uptrend. So these are just a few examples of the ETFs that I currently own. So let's talk about entering a market after the trade signal occurs. And I do this quite often. This is the major trend system is a very long-term system, so I don't always enter when the buy signal occurs. Sometimes I'll wait and see how the trend develops, and then I'll jump into a market after a buy signal. And what I do is I use a shorter-term timing tool to help me enter the market. And here's an example. Here's the current healthcare sector ETF. We can see it's in a very strong uptrend, and you might want to enter this market after the buy signal has occurred. So here's the same time period for the XLF healthcare sector with the Keltner channels. And I like to use the Keltner channels to help me time my entry after a buy signal has already occurred. And we can see with the healthcare sector, we have the price of the ETF is this line right here. And the Keltner channels, there's three channels. There's the upper channel, which is this blue line. There's the middle channel, which is the dotted line, and then the lower channel. And these channels act as overbought, oversold indicators. So if you want to get into a market after a buy signal, it's better to wait till the price retraces to this middle Keltner channel or even the lower channel. And you can see that's presented some good buying opportunities long after the ETF was on a major buy signal. So we can see it's been on a major trend signal for a long time, and over this same period of time, there's been numerous times when you could have gotten a lower risk entry by using these Keltner channels. And you can see that when the price of the ETF gets up near this upper channel, the ETF is getting overbought, and then it usually retraces back to the middle channel or the lower channel. And conversely, if the price of the ETF drops down towards the lower channel, then there's usually a rally. That means that the stock or the ETF is getting oversold at this point, and you can see that after this oversold period that there's normally a rally. So we can use these Keltner channels to help us time to get into a market after a buy signal has already occurred with the major trend. So we can see we've had numerous opportunities to enter this healthcare sector when the ETF became oversold. Now what I did was I did some historical testing of the major trend system during the last bear market. And what I wanted to do with this test is show you the advantage of a system that takes short trades in addition to long trades. And what I did is I tested GPS, the major trend system, over these 8 global markets: crude oil, the emerging market index, Latin America, Europe, the euro currency, 20-year treasury bonds, the Brazil index, and the S&P 500 index. So what I'm trying to do here is show you that these historical tests occurred, and there was 2 bear markets during this time period, and the GPS system was very profitable despite these 2 bear markets because it takes short positions. And what I did is I divided up the initial investment of $10,000 across those 8 markets and tested it over a 13 3/4 year period. And this $10,000 investment produced $111,000 in profit. So the total return was 1,110%. And again, over this time period, there were two severe bear markets. We had the bear market in 2001 through 2002, and you can see that this portfolio was profitable. And then we had the bear market between 2007 and 2009. And again, you can see that the portfolio was profitable because it does take short positions and does profit in down markets. And another important stat with this was the system had a profit factor of 45 to 1. So for each $45 of profit, it only had $1 of loss. So that's a good measure of the risk of the system, and it usually gets you out before a major loss and keeps your risk to a minimum. So we had, during that testing period, we had $45 profit for each $1 of loss. So once we identify ETFs that are in a buy mode, there's 4 different types of trades we can take. We can purchase the ETF, purchase call options on the ETF. We can do covered calls and bullish option spreads. And if the major trend system is on a sell signal, we can purchase short ETFs, and I'll show you some examples of that here shortly. We can purchase put options, and we can also do bearish option spreads. Now, in one of my advisory services, we do have an ETF portfolio, and I took a snapshot of the current profit results, and I used the major trend system to identify buy and sell signals in this portfolio. And we currently have an open trade profit of $140,000, average return of 83%. And this is a broadly diversified portfolio with many different markets, world markets. And I took a snapshot yesterday of my current profits in 2 of my retirement accounts for my ETF purchases. And I used the major trend system to purchase these ETFs. So I have about $177,000 in open trade profits in these 2 retirement accounts. And here's a snapshot of my 2 retirement accounts several years ago. And at that point, I had a $528,000 profit. And most of these positions in these 2 retirement accounts were ETFs. So I've been using the major trend system for many years, and it's been very profitable in both up and down markets.
Quick question for you, Chuck.
Yeah.
Do you have favorite ETFs you look at, or is it really based on just, like you said, the market trend, and then you focus on this particular ETF with that trend?
Yeah, that's a good question. I like to look at the price chart, Tom, and then I don't necessarily go for the ETFs with the highest relative strength. I go for the ETFs that have the smoothest trend picture. In other words, when I look at that 1-month price in relation to the 20-month EMA, I like to go for the slow, steady, trending markets as opposed to the really volatile markets that carry a higher risk. So I just look for the slow, steady trenders usually, and using this major trend system is a very easy and quick way to see where that future price of that market is probably heading. So it gives us an instant picture of the trend, and I like to go for the slow, steady trends.
And that's always going to be correlated to the time or the duration that you hold on to your position, is my assumption.
Yes, yeah, that's going to depend on the time that you hold your position, and the ETFs, of course, can be traded in smaller accounts. You just trade a smaller number of shares. So even small accounts can take advantage of these price trends by trading a smaller number of shares in the ETF. So let's now talk about using the major trend system to trade ETF options. And in general, trading options allows you to start small. And I've been investing in options for more than 28 years. And when I first started out trading options, I only had a $4,600 trading account. But within my first 2 years of investing, I realized more than $460,000 in profits, starting with that $4,600 trading account. And here's some snapshots of those first 2 years of option trading, where I made over $460,000 those first 2 years. These are copies of my tax returns. So the reason you can start small with options is because of the leverage that options provide. And I'll show you some examples of option trades that I took so you can understand this concept of leverage. Now, if you want to profit using options, options are derivatives that derive their value from the price of the underlying ETF. And the intrinsic value of a call option will increase 1 point for each point the underlying ETF increases above the strike price. And the intrinsic value of a put option increases 1 point for each point the underlying ETF decreases below the strike price. So if you want to profit using options, you have to identify the trend and then determine whether you're going to take a bullish or bearish position. And by using the major trend system, we can identify markets that are bullish and buy call options, and we can also identify markets that are bearish and we want to buy put options. So the way to profit in options is to look at the price movement of the underlying ETF. That's what determines your profit or loss in an option position. So that's the most important criteria when you're trading options. So we want to use the major trend system to find ETFs moving up in price so that we can purchase call options. And then we can also use the major trend system to find ETFs that are moving down in price, and then we want to purchase put options. And again, your profits when you're trading options are going to be determined by the price movement of the underlying ETF. So that's the most important criteria that you want to look at. Okay, let's take a look at some actual option trades that I took using the major trend system. And these markets were on a buy signal when I purchased these options and option spreads. And here's an example of the Brazil fund, and I purchased call options and option spreads on this ETF based on the major trend buy signal. And we can see the 1 month price of the ETF is above the 20-month EMA, so the Brazil ETF was on a buy signal, and I purchased bullish call options and option spreads. Here's another example. This is the Europe, Australia, and Far East Fund. This was on a buy signal. The Builders Emerging Markets ETF was on a buy signal. And the last one is the Global Energy. So I'm going to show you my brokerage account statements that show positions in these 4 markets. And this portfolio had a $50,000 profit and an average return of 70%. So again, I purchased these options and option spreads based on the major trend buy signal that I had at the time. So these are just examples of option trades I took using the major trend system. Now let's look at the leverage that options provide, and I'll show you some actual examples, and we'll compare the return of the option to the return of the ETF, and you can see that these options are leveraged about 6 to 1 to the ETF. And this first one I'm going to show was the emerging market ETF. It was on a buy signal according to the major trend system. So I bought 5 of the June 100 strike call options at 14.20. Then I later sold these 5 options at 29.30, and I had a $7,500 profit, net profit after commissions, and a 106% return. And over the same period of time, the emerging market ETF was up 16%, and the option was up 106%. So the leverage the option provided was about 6.6 times the leverage that you would get from owning the ETF. So this is just an example of the leverage that options provide. Of course, that can work both ways. If the ETF goes down, then you're going to have a much larger loss than owning the ETF. So it works both ways, but if you can time it right, you can get a good return using options because they're leveraged. And here's a profit graph. This compares the ETF return. This is about a 6-month period, and we can see that was about a 16% return versus 106% return for the option over the same period of time. So this just shows you the leverage that options provide. And if you were compare the investment and the dollar risk, if you bought 100 shares of the ETF, it would have cost at that time $11,130, and over that period of time you would have had a 16% return, and as opposed to the option, instead of costing $11,000, the option was $1,420, and that had a 106% return over the same period of time. So this just demonstrates the leverage that options provide. And here's another example. I bought 10 of the Brazil ETF 45 strike options at 8.20 and bought 10 of the Builders emerging market 34 strike options at 5.20. Sold the Brazil options at 14.90. That resulted in a $6,600 profit, 82% return. And the Builders emerging market, that had a 104% return. And over the same period of time, the Brazil ETF produced a 14% return versus 82% for the option. And the Builders ETF had a 16% return versus 103% for the option. So again, these options allow you to get a higher rate of return compared to the ETF over the same period of time. And on average, those 3 trades that I took had about 6.2 to 1 leverage compared to the underlying ETF. So let's now take a look at profiting in down markets, and here's the major trend chart for the emerging market index, and we can see the 1-month price above the 20-month EMA right here, but then in April or May, I guess this is around June, of June of 2008, the 1-month price crossed below the 20-month EMA. So now the emerging market ETF is on a sell signal. So once that occurs, you want to think about exiting your long positions and start taking short positions. Again, this is the major trend. This is the long-term trend of that ETF. And when that 1-month price drops below the 20-month EMA, that's usually a sign that that market is now bearish, and you should definitely not be taking bullish trades when the major trend turns bearish. So I found over time that shorting a stock or an ETF incurs too much risk. So what I did to take advantage of this sell signal was I simply bought the short emerging market index. This is an inverse ETF, symbol EEV, and this moves inverse to the emerging market ETF. And my brokerage statements here show that EEV, which is the short emerging market index ETF, I bought 600 shares, and at the time I had a $9,155 profit. So this short ETF, EEV, that profits if the emerging markets ETF is going down in price. So the major trend had turned bearish at that point, so I was in all bearish positions in various global markets at that time. And here's a snapshot of one of my portfolios. This was on September 15th, 2008. And on that day, the Dow dropped 504 points. And I closed out trades that day totaling over $14,900 in profits after commissions. And I had an open trade profit of $18,262. So I had a 14.5% return on the day that the Dow dropped 504 points. So that shows you the advantage of taking these short positions during down markets. So,
Chuck, do you ever correlate ETFs with your long positions as a hedge, or do you keep them completely separate?
The question is, do I use the short ETFs in conjunction with the long ETFs as a hedge? And I usually just follow the major trend system, Tom, and if the market is on a sell signal, then I'll take a bearish position. If it's on a buy signal, I'll take a bullish position, but I don't really correlate the bearish and the bullish positions. And right now, we don't have that many bearish positions on, and but that that can certainly change. And the last two bear markets, we were heavily short, and we had great profits in the bear markets with these short positions. Now let's talk about trading covered calls with ETFs, and this is another one of the strategies I'm very actively involved in. And the GPS covered call strategy is designed to generate income from selling call option premium. And a covered call is initiated by buying an ETF and writing or selling the related call option. Normally, one call option is sold for each 100 shares of an ETF that is purchased. I'll show you some examples of that. And there's the two main objectives with the covered call strategy is to generate income from the sale of the call option and to provide downside protection in the event that the underlying ETF declines in price. And these covered calls can be written on bullish or bearish ETFs, enabling you to profit in up or down markets. And I'll show you some examples of a covered call on a bearish ETF. So if you write these covered calls on a bearish ETF, you can profit in a down market. And a covered call on a bearish ETF, it would be a limited risk strategy, and as compared to just being short the ETF, which would be a high risk strategy. So when we want to take bearish positions, we either want to do one of these bearish covered calls or buy a put option. So here's an example. of this is the price chart for the Russell 2000 index, which is the small cap index. We can see that the small cap index is on a buy signal with this 1-month price above the 20-month EMA. So what I wanted to do is wait for a retracement in that small cap ETF, and then I wanted to take a covered call trade. So what I did is I waited until, and here's a price chart of the small cap daily price action over the same time period, and this also has the 3 Keltner channels. So you can see when the small cap got overbought, it retraced, overbought, retraced, overbought, retraced, overbought, retraced. So what I wanted to do is wait till it became oversold and then take a position in this small cap ETF. So we can see right here, November of last year, the small cap ETF became oversold right here, and that's when I initiated this position. So this is just an example of using the Keltner channels to help us enter a market that's in a strong bull market when it has a temporary retracement. So what I did is I bought 400 shares of the TNA, which is the leveraged small cap ETF, at 51.22, and then I sold the 55 strike calls at 15.32. These were Leaps options. So I waited for that retracement in the price and waited till the ETF became oversold and then entered this market with a covered call trade. So the sale of that call option at 15.32 and buying the ETF at 51.22, that sale of the call option allowed me to purchase the small cap ETF at a 30% discount. And the call option that was sold, that profits if the price of the ETF goes down and from the time decay of the short option. So in this example, once you buy that ETF at a 30% discount, you could actually profit from this trade whether the ETF goes up, stays flat, or even decreases in price. And I just wanted to mention the TNA has since had a 2-for-1 stock split. So I purchased it at 51.22, and after the stock split adjusted, my purchase price was about $26. So let's take a look at the details on this particular trade. I got a 30% downside protection once I initiated this covered call trade, and a small increase in the price of the ETF at option expiration can result in a 53% return on the covered call. If the ETF is flat at option expiration, I'd have a 42% return, and if the ETF declines 20%, I would still get a 14% profit with this covered call trade. Now let's compare these results for the covered call trade to a call purchase trade. So let's assume on the same day that I did that covered call trade, instead of doing a covered call, I purchased this 55 strike call at 15 points, 15.32 points. So what I'm doing here is comparing the return for an option purchase versus a covered call. And we can see with the option purchase, if the ETF increases 10%, you have a 91% loss on this option purchase. And if the ETF remains flat, you'd have a 100% loss and if the ETA decreases, you'd have 100% loss. So what this demonstrates is the difference between a covered call and an option purchase. With a covered call, the underlying ETF doesn't have to go up in price, and you can still profit. If it's, in this example, if the ETF was flat, I get a 42% return. Even if it declines 20%, I still get a positive return. So with the covered call, you can still profit even if the ETF is flat or goes down, as opposed to purchasing a call, then the ETF has to move up in price for you to profit. So here's an example. Again, with the covered call, a 10% increase would result in a 53% return. If the ETF is flat, that's a 42% return. If it's down 20%, it's a 14% return. So you compare that to a 10% increase in the call purchase, which would result in a 91% loss. So the bottom line with these covered calls, you don't have to be that correct on your market timing when you do these covered calls, because you can profit even if the market's flat or goes down. And this is a really good strategy during volatile markets when we can see this price chart of the S&P has a lot of price volatility, but it's not trending. So the covered call trades work well even in this type of market. And here's the buy right covered call analysis for this TNA covered call. And what this does, it calculates the profit potential for this covered call trade, assuming various price changes in the underlying ETF from, in this example, a 10% increase to a 20% decline. So the covered call analysis allows us to take a look at the profit potential for a trade before we take that trade. And I'm going to just quickly go through an example of a bearish covered call trade. This was on the emerging market index, and again we can see the 1 month price drop below the 20-month EMA right here. So now this market is bearish. So I took a covered call trade, and the way I did that is I bought 300 shares of the emerging market short ETF, symbol EEV, at 96.80. So this brokerage statement shows the purchase of 300 shares at 96.80. And then a couple weeks later, I sold the EEV call option, 120 strike call option at 20 points. So I was establishing a covered call position in the short ETF. Now this covered call position is going to profit if the emerging market index goes down in price. So this is an example of profiting in a down market using a covered call. And here's the covered call analysis for this trade. Again, buying the short emerging market fund at 96.80, selling the 120 strike call at 20 points, and this assumes various price changes in the short ETF from a 25% increase to a 15% decrease. And we can see that if the short emerging market fund goes up 25%, I'm going to have a 56% return. If it goes up 10%, I'm going to have a 38% return. If the ETF is flat at option expiration, I have a 26% return. So again, this is a way to profit. This is actually a short position, even though it's a covered call. And this covered call profits as the emerging market fund goes down in price. So it's a good way to profit in down markets. And here's another example of a LEAPS covered call for the Brazil index. And I bought the Brazil index at 33.69 and sold the 40 strike call at 710 points. And this option expired in about 15 months. So this is another example of a leaps covered call, and we can see the 10% increase in the Brazil fund at expiration results in a 39% return. If the ETF is flat, I get a 26% return. So again, with these covered call trades, you can profit even if the ETF is flat or goes down in price.
Chuck, we're getting a question several times. Do you ever take the opportunity, if a position goes against you on a covered call, to perhaps purchase back those options at a cheaper valuation?
Yes. The question is, if the ETF goes down in price, the short call is also going to go down in price. And yes, if the short call goes down, let's say 85% from where I sold it, then I'll just go ahead and automatically buy it back and sell another call. And I normally use a good to cancel order to buy back that short call, so it automatically buys it back if it drops 85% from where I sold it. And then I'll go ahead and sell another call option, and that allows me to collect additional premiums. So yes, to answer your question, you do want to exit short calls when they don't have much protection left. Now you can also trade covered calls, ETF covered calls, with weekly options, and I'm very active with this strategy. And the way this strategy is initiated is you buy 100 shares of a ETF, and then you sell a weekly call option. And when you sell a call option, of course, that premium is immediately credited to your brokerage account. And with weekly options, you get to collect this premium every week. So if you sell a weekly call option with 4 points of premium, $400 in cash is credited to your brokerage account right away. And this cash reduces the cost basis of the stock or ETF and reduces the overall risk of the trade. So if you sell one of these call options every week, it allows you to quickly compound your returns. And I'm going to show you an example here of selling an option premium each week that would allow you to collect over a 100% cash-on-cash return over the course of a year, regardless of the price movement of the underlying stock or ETF. And I'll show you an example of one that I've been trading for a while now, and I trade this every week, and I collect about a 2.5% premium each week. Now, over the course of a year, with that covered call, I'm collecting about 130% cash-on-cash return. So it's hard to go wrong when you're collecting 130% cash-on-cash return. So let's look at an example of that. And just to explain weekly options in case you're not familiar with them, the weekly options start trading on Thursday and they expire the following Friday. So they have a life of 6 trading days. So this gives you 52 opportunities each year to sell an option premium with a covered call. And you can roll over your profits every week and then compound your returns by initiating more covered call trades, which I've been doing for many years. Now, over the last 3 years, I had over $1.1 million in actual profits with these covered calls. And this was during a very volatile, non-trending type market condition. So this weekly covered call strategy has been working well over the last several years, even though we've had a lot of price volatility and very little trend. I've generated over $7 million in gross option premium with these covered calls over the past 5 years. So I've collected over $7 million in cash income into my accounts from selling this option premium, and these were mostly retirement accounts. And I've made as much as $68,000 in profits over a 1-month period with these weekly covered calls on ETFs. So let's just quickly go through one of these ETF weekly covered calls. And option basics, the time value, if you're short an option, the time value of that option becomes profit at option expiration. So if you sell an option premium on Friday, the following Friday, the time value portion of that option premium becomes profit regardless of the price movement of the underlying ETF. And option basics, the options consist of time value and intrinsic value, and at the money or out of the money calls consist of only time value. So I normally sell the at the money call, which is all time value. So in 1 week, if I'm short that call in 1 week, that time value becomes all profit, regardless of the price movement of the ETF. Let's look at an example. This is for the small cap, the leveraged small cap ETF. And at the time, the ETF was trading at 54.27, and I had already owned the ETF. So what I do is each Friday I simply roll over the options. That way I get to keep my ETF and it doesn't get called out. So I just hold the ETF in my account. Every week I roll over the option premium and sell the new option. So in this example, I was buying to close the November 23rd weekly option at the 52 strike November 23 weekly option, and I was selling to open the new option, which was the November 30th. So I was closing out the expiring option, selling the new option, and I used a option spread order to do this. And this helps save on the commission and the transaction cost, the bid-ask transaction cost. And we can see with the TNA trading at 54.27, if I sell the 54.5 strike, that's actually out of the money, and that's all time premium. So I actually collected 1.42 points for each contract for this weekly option. Collected a total of $1,125 for this weekly option trade. And again, that was all time value, so that all becomes profit at option expiration, regardless of the price movement of TNA. So if I had already owned TNA at that point, but if you were to initiate a new covered call trade, you would have paid $54.27 for TNA minus the 142 option premium. So your cost for this covered call trade at that point would have been $5,285. And so your initial investment is $5,285. Now, if I collected a similar premium each week over the course of a year, I'd collect $7,384 in cash, and that works out to be 139% cash-on-cash return for my initial investment of $52.85. So a lot can go wrong, and if you're collecting 139% cash-on-cash return, this trade will still be profitable. And I roll this trade over every week, and I've been getting a similar premium each week with this trade. So even if TNA declines 20% or even 40%, I can still realize a profit with this trade. And again, this TNA had a 2-for-1 stock split since I made these slides. So you just have to keep that in mind. Right now it's trading around 49. So a lot can go wrong with this trade, and I'll still profit. If the underlying stock or ETF declines substantially, you can still profit. And if you had bad timing when you entered this trade, you could still profit. So I'm collecting on average about 130% cash-on-cash return by selling this weekly option premium on the TNA. You could have volatile price swings in TNA and you could still profit. So this gives us a big advantage compared to a directional trade where the ETF has to go up in price in order for you to profit. So even if the ETF is flat, you can still get a good return with this strategy. And also, a lot of times these directional trades, if you use money management, these directional trades can get stopped out if there's volatile price swings. So again, there's a lot of advantages to this weekly covered call strategy if you're collecting over 100% cash-on-cash return. A lot can go wrong and you're still going to profit. And I'm just showing a few snapshots. These are weekly options that I sold over a 1-week period, and this right-hand column has the dollar amount after commissions that was credited to my brokerage account. And these are all time value premiums, so the time value, when it decays to zero at expiration, that time value becomes profit. So here's a snapshot. January 11th, I collected $14,929 in weekly option premium. This was last year. February of last year, I collected $13,588 in time premium. This was April of last year. I collected $16,000. So I've been very active with these weekly covered calls. This has been a very lucrative strategy and has made money for me regardless of the type of market conditions that we're in. Here's a week where I collected, this was about a year ago, May 16th, I collected $28,000 in time premium. Okay, that concludes my presentation for today. And if you want to see how these various strategies are performing, you can just log on to the weeklyoptionalert.com and click the trade results link, and it will give you the current trade results for these various strategies. So that concludes my presentation for today, and I'd be glad to take any questions.
Yeah, Chuck, regarding, it looks like there's a different approach when you use the ETFs as opposed to the weeklies. Do you have a set dollar amount that you allocate in your portfolio for weeklies and ETFs and kind of stay disciplined to that?
Yes, the question is how do I allocate my funds for the weekly covered calls versus ETF purchases and stock purchases, and I have about half of my funds, a little more than half of my funds in these weekly covered calls. And the other half is in ETFs and stocks using my trend following systems.
Another question that kind of came up across the tape more than once is, do you change your moving averages, Chuck, depending on one of those two strategies?
Question is, do I change the moving averages? And the answer is no. What I like to do is I'll purchase a stock or an ETF using the major trend system and following that discipline. But then in my portfolio, I'll also purchase stocks and ETFs with a shorter term trend system that has a shorter term time horizon, which is the 50 and 100-day EMA. So I like to mix it up between the shorter term trend following with the longer term and kind of diversify my portfolio that way.
Sounds great, Chuck. I know a lot of you have a lot of questions. We could probably be here for several days, and Chuck could probably sit back and answer all these questions, but due to time constraints, we're not going to be able to do that. If you have questions regarding Chuck's program, by all means, feel free to contact Brad. That's his contact information, or send them an email. Support staff would be happy to address any of those questions for you. For those of you that haven't been on a webinar, for those of you that have, we do archive this. Chuck, I'm going to take the reins back just so you know.
Okay.
But what we'll do is Chuck's been kind enough to do these webinars with us on a monthly basis. And if you actually go back to mytrademonster.com, which I'm pulling up now, you'll be able to view some of Chuck's past webinars and actually see some of the past recommendations that he's made and the performance on these things. This one will be listed tomorrow right here under the month of May. So feel free to come back, visit, download it, play it back, contact Chuck's support staff. They're more than willing to help. And more importantly, Chuck, I want to thank you again for coming out. That was a pretty long webinar, a lot of information, and I know a lot of people are going to be asking some questions for that.
Okay, great. Yeah, thank you, Tom, for taking the time to put on these webinars. We all appreciate it, and looking forward to next month's webinar.
Yeah, that would be great, Chuck.
Everybody.
Thanks a lot, Chuck. I hope you have a nice weekend. And to everyone out there, if you have any questions, feel free to contact us on myTradeMonster. Otherwise, we'll have Chuck's webinar listed tomorrow in the archive section. You could download it or play it back. Again, thank you, everybody, for attending. Trade like a monster. And again, Chuck Hughes, thank you very much for taking the time to do this.
Okay, great. Thank you, Tom, and have a great day.
Good night, everybody.